Hi, my name is Ben Connard. I'm a portfolio manager at Eagle Ridge, and today I'm excited to talk about one of the factors driving the current market's elevated price to earnings multiple, or PE multiple. One of our favorite charts, shown here, explains it well. It's simple, but really helpful. Let's take a look. The green line is the PE multiple over the last 50 years. We are using the S&P 500 to represent the stock market. This valuation metric represents the price investors are willing to pay per dollar of corporate earnings. The tan line is the 10-year Treasury yield over the same time period. This represents how much money investors are paid for holding a 10-year Treasury. As shown, as the Treasury yield goes up, the PE multiple goes down, and the converse is true. As the 10-year Treasury yield goes down, the PE multiple goes up. Why are they correlated? Because they both represent the price of risk. The yield on the Treasury is how much money you can make while taking minimal risk. It's extremely safe, but your returns are limited. The S&P 500 is a risky asset. The multiple is how much investors are paying for that risky asset. You're buying tiny pieces of public companies. And unlike the US Treasury, these companies are not backed by the federal government. However, they have far greater upside than a Treasury. And in general, they have more upside when you pay less, i.e. the multiple on the market is low. And the converse is true. Paying more due to higher multiples means less upside. Think of the relationship this way. If I get paid a lot for taking no risk, I'm not going to turn around and pay a lot for taking risk. This lowers the demand for risk, which results in a lower PE. Let's try a fun example. If I'm at a carnival with the option of taking a low-risk layup or a high-risk three-pointer to win two different prizes, my choice of which shot to take will be driven by the reward. When the Treasury yield is high, it means the carnival will offer a nice prize, like this toy narwhal, for making the layup. In this case, the carnival needs to offer an even better prize, like this large stuffed bunny, for me to risk the three-point try. This need for more upside keeps the PE multiple low. Now in today's low yield environment, the carnival isn't offering a nice toy narwhal for the layup. Instead, it's offering this small stuffed bear. So now, it only has to offer me a decent prize for trying the three-pointer in order to generate demand. Maybe even the toy narwhal from the high yield environment. This need for less upside has allowed the PE multiple to increase. What does this mean for the future? As we discussed in a recent market commentary, high PE multiples tend to result in lower returns in the future. Market returns are a function of earnings growth, dividends, and PE multiples, but we'll explore that in a future video. Thank you.